There, ExxonMobil employees, and thank you so much. We're so happy to have you here today. My name is Sam, and I moderate these weekly webinars. In just a second, we'll be joined by Wesley Boudreau, who's going to be answering some of the more frequently asked questions we've been receiving lately from other ExxonMobil employees. I apologize in advance. We will not have time today to answer any of your questions live, but I encourage you to still ask away. It's completely anonymous. And we'll make sure one of our ExxonMobil focused financial advisors can answer those questions with you either through phone or email after the presentation has ended. As a quick reminder, we are not affiliated nor endorsed whatsoever by ExxonMobil. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along today. And throughout the presentation, you will see some links popping up at the very top of your screen above my head there. You can click on those links and they're going to guide you to various resources we have available, one of which will simply be a link to our calendar where you can book an appointment with one of our ExxonMobil focused financial advisors. Other links may simply lead you to our YouTube or our LinkedIn where you can follow us for much more ExxonMobil related content. We post tons of content weekly, and we really think you'd get some value out of it if you considered giving us a follow. And with all of that out of the way, we're going to get started with Wesley Boudreau.
All right, thank you very much for that introduction, Samantha. And like she said, today we're going to be going over the ExxonMobil pension plan and talking about some different questions we've been getting recently, the last couple of months or so. These are really similar questions we've gotten in years past as well. But we're going to highlight some of those and kind of dig into some different issues you may see as an ExxonMobil employee. Even though myself and some of their advisors here at the retirement group have worked extensively with ExxonMobil employees and we're focused advisors for Exxon, that does not mean that we're endorsed or employed by ExxonMobil. But any questions you have outside of these, or even if you want to elaborate on some of these, give me a call. We'll be happy to dig into those and help you with those situations. So we're going to throw just a couple in here to keep your time short. We got 4 questions that are going to pertain to the pension plan, and I decided it's pretty important. We'll throw one more in there that we've been getting recently with the 401k plan as well. So with that, let's jump into the first question we have here. Okay, someone told me wait until 60 to get my lump sum. Is that right? Well, it really depends. Generally speaking, yes, as far as if you want to maximize your pension, you need to keep in the back of your mind that 60 is when you get 100% of that pension. Really, the key thing to keep in the back of your mind is 55 plus 15. So, what that means is you need to make sure you make it to age 55 and have 15 years of service under your belt to be considered a retiree whenever you leave. And at that point, if you make it to 60, that's when you capture 100% of your pension, whether you take the annuity or lump sum. It doesn't matter. It's just a matter of what percentage of your pension you're getting. If you decide to actually retire and commence your benefits prior to that, there's a 5% reduction each year. So let's say if somebody did it at 57, that's 3 years short of 60, so a 15% reduction, you're only going to get 85% of your pension. However, that may not be the end of the story. You may say, okay, well, yes, I don't want 85% of my pension, but if I'm leaning towards a lump sum, then interest rates may be an adjustment as well, in which case, if we are in a rising interest rate environment, you could see those interest rates go up and offset that 5% potential growth you'd have just by aging out of the penalties. So it's really important to kind of look at these one on one. I can tell there's countless times where we've sat down with individuals, and even though it is a situation where it would make sense to defer till 60 if everything else was held equal, things are not equal, and we're in an interest rate moving environment, in which case it made sense to go ahead and elect that pension upon retirement. On the flip side, if we're in an interest rate environment where it's going down, you kind of it's a double benefit for you because you're aging out of that 5% penalty, and the interest rate going down will actually increase your lump sum if you are taking a lump sum. If you're taking the annuity, that doesn't matter. The annuity is only going to be affected by that percentage base on whether or not you're getting to age 60 or not. Now, if you're not 50 and 15, then you're a terminee, and there's even deeper discounts there, which we can go on a one-on-one basis. But again, try and make it to 55 plus 15 as a bare minimum with as an ExxonMobil employee. So another question, what happens if interest rates drop significantly in the future? Should I delay my retirement to take advantage of a potential increase in my lump sum? So I just elaborate a little bit about the interest rates and how they affect the pension plan. So what happens is the pension plan is a classic defined benefit plan, in which case there's a formula they use in order to determine what your single life annuity is going to be. Then from there they can dictate, or you can pick whether you want a single life annuity, joint and survivor annuity, period certain, or a lump sum. To get the lump sum, they look at interest rates and a net present value calculation based upon your life expectancy to figure out how much does Exxon need to give you for you to essentially go out there and recreate that same paycheck. So when interest rates are high, they don't need to give you as much. When interest rates are lower, they need to give you more. So think about it like the reverse of a mortgage. You know, when interest rates are high, you can't borrow as much, you can't get as big of a house. When interest rates are low, you can afford more. So we're in that point in time of the last couple of years where we saw interest rates going up, and that was driving up the prices of mortgages, but also driving down your lump sum. So if we fast forward, we've been on that pendulum swing where we saw interest rates go artificially too low during the pandemic, then kind of on the other side go a little bit too high. The last couple of years, they've come down a little bit, but now they're kind of leveling off, and they may kind of go up or down slightly from here. So with that being said, yes, it does make sense to look at this and potentially defer if we know the interest rates are dropping. We did this for a lot of people back during the pandemic, watch those dropping and deferred. We also did it last year. We saw interest rates kind of coming down from the summertime down to about October, November, which affected first quarter interest rates for 2025. Now the opposites happened. They've come up a little bit, so we're on that potential wait and see, or just pulling that trigger if you want to get out and get that lump sum situated. But again, this only focuses on the lump sum. The interest rates have no bearing on the annuity. So again, it's really important to run a cash flow analysis and get into the system and look at those side by side, look at the options and look at what that means, whether or not you defer or whether you defer out based upon interest rate changes, and we can calculate those out for you. And the beauty of it is you got a little bit of a quarterly crystal ball because those interest rates come out about a quarter ahead of time, so we know what they're looking like. Okay, so another question here. Um, is the annuity better than the lump sum if I want income, or are there other options? So again, this is all a personal situation. I'd say, obviously back during the pandemic when interest rates were low, 95, 99% of people took that lump sum because it made more sense. Now that we've had interest rates come up, and I don't want to say it's equalized, but it does reduce that sheer benefit of the lump sum when you look and comparing those side by side. It's really important to run a cash flow analysis and look at these over the next 10, 20, 30, 40 years even to see how that annuity versus a lump sum would look for you based upon different variables and hypothetical rates of return. But generally speaking, as far as an annuity, who it's best for, I would say for those that have maybe spending problems, you want to make sure that, hey, I get a steady paycheck. I don't want to get a lump sum and take the risk of burning through that, whether it be myself or my family coming out of the woodworks and asking me, and I'm too nice to say no. Also, if you have mismanaged money in the past, or you may be looking at a DIY approach on your investment strategy and taking too much risk, you could get that $500 million lump sum and turn around and cut that in half in a matter of a year or two if you make some mismanagement choices. So it's really important to kind of understand that. And there's also flip sides where if you think you can get, 5 to 6% rate of return, then it may make more sense for that lump sum. But you need to be steadfast on making sure that you've got a good sound investment strategy, whether you're doing it yourself or working with a firm like the retirement group. And then that also employs the pension lump sum, gives you more tax favorable treatment as far as tax planning strategies down the road. Now, as far as if you say, okay, I've gone through all this, and yes, the annuity makes the most sense. The beauty of Exxon is you have, it's not just all or nothing. You can take a half and half or 75-25 mix. I think the next question might go over that, so we'll get into that later. Um, but if you say, I do want the annuity, then it's really just a matter of comparing, okay, what's that annuity going to pay me? Or what a lot of people don't understand or didn't realize before is I could take that lump sum and maybe get my own private annuity or a couple annuities if I wanted to spread the risk around. Because if you get the annuity through ExxonMobil, it's going to be fixed and it's not going to grow for inflation. And God forbid something happens to you and to your spouse if you're doing a joint, then ExxonMobil keeps the rest of that. So we saw a lot of this during coming out of the pandemic when interest rates started going up. We saw some huge differences in taking the lump sum and annuitizing yourself. We saw differences of $500 to $1,000 a month more. Those have kind of leveled off where it might be that somebody says, okay, I've got a $3,000 a month annuity. What can we do with the lump sum? Well, that lump sum might get you maybe 31 or 3,200, maybe 2,900. So somewhat comparable to what ExxonMobil can do. The difference is it's your money now. So if something happened to you sooner in life, there's still money to pass on to beneficiaries. Maybe that you want some other adjustments to it, maybe cost of living adjustment, things like that. We can go into all those with you, but that's kind of a one-on-one basis. So again, even if you're thinking about taking the annuity, it's still important to review that lump sum because the first step may be taking the lump sum and then annuitizing it on your own. So another question here. Like I mentioned, with so many split option strategies available between the annuity and the lump sum, how do I pick? So this was, I think, in 2015, if I recall, when this kind of came into play. It used to be that just like most all pension plans, it was either 100% annuity or 100% lump sum. But one of the beauties of ExxonMobil is they broke that up in 25% increments. So now you can take a 25% lump sum, 75% annuity, a 50-50, or 75-25 if you want to. So you can have your cake and eat it too, because a lot of times you may not need all that income, or you don't want to be stuck with all that income for tax planning purposes. So you might say, well, let me take half as an annuity and half as a lump sum. That goes back into that aspect. Even if you said I want half and half, it may make sense to do 100% lump sum and take half of that and get your own private annuity. So you just need to review those and look at it. But really, the only way to kind of decide on this is, like I said before, that cash flow analysis we provide, that's complimentary, but we can run as many scenarios as you want. So we can go in there and say, okay, well, what does it look like, not just now, but over the next 20, 30, 40 years, if I were to take the annuity, just the annuity, versus if I took the 100% lump sum, or if I took a 50-50, 75-25. We can go through all those variables and kind of show how they play out over the coming years. And that's really the way to kind of help back into this. But again, it also goes to that previous question I mentioned, what your nature is. If you're if you have spending issues and things like that, that also goes into factoring with the annuity and where the market is as well. So one other I kind of added there, just because we're getting this question a lot as well, and it's something that I've seen so many mistakes from ExxonMobil prospects and even on the Voya side, so you want to be careful about it, and that's NUA. So how do I know if I have net unrealized appreciation, so NUA, and when do I take it? So the best way to do this to be very safe is just to get us a copy of your recent 401k statement from Voya. The beauty of ExxonMobil, unlike other plans, is they give you a line-by-line cost basis. So they show you the history of when this was purchased by yourself and ExxonMobil. So we can go down there and actually trigger NUA based upon a certain cost basis level. Whereas most other 401ks, it's just the average cost basis. So you don't have NUA as much, but you may have Exxon stock as low as $14, $15 a share. If you've gone and traded back and forth, you may not have NUA because you've traded through that. But if you've held some of that, you may have some really low cost basis. So a quick, refresh on what NUA is. It's net unrealized appreciation. The difference, if you said, "Hey, Wesley, I just rolled over my 401k and everything's fine," if you talk to a different advisor that didn't understand NUA, what happens is any distributions from there, assuming it was mostly pre-tax money, would be tax deferred, and eventually you pay ordinary income tax on it. On the flip side, in UA, if you've got low cost basis, you only pay ordinary taxes on the cost basis. The growth that you have whenever you sell it, whether it be in a day, a week, or 10 years, you're paying long-term capital gains, which historically has always been lower. Right now, they're at 0, 15, and 20%. So theoretically, we could actually stretch it out over the course of years and have 0% tax on there. So a quick example, you might have a $100,000 worth of ExxonMobil stock that's only got a 20,000 cost basis, so you pay taxes on that 20,000, and that 80,000 of growth, you would pay long-term capital gains, which again could be 0 or 15%, but likely it's always going to be lower than your ordinary income tax. So you're probably saving at least 7% or more on that 80 grand. So that could be 15,000 or so there. So again, just something to take a look at. That's outside of the planning side of things as far as the pension, but that's as far as letting us take a look at that 401k, making sure you're diversified appropriately, and then getting that plan put together. So again, I mentioned it before, but right now about 3/4 Americans over 50 don't have a plan. Give us about 10 to 15 minutes gathering some data from you, and give us a couple of days to put that plan together. We'll get that first draft, if you would, of a financial plan, show you what you look like, help you determine when to retire, how to maximize those benefits, let you know if you need to make any adjustments. And then once we've kind of done that, we can go in there and dig deeper and tweak it and make some modifications if you need to, and be more specific on some of that planning. But with that, again, a quick reminder of who the retirement group is. Again, we've for the last 30 years or so, we've been working with corporate employees, helping them transition into retirement. A large chunk of that time has been spent with ExxonMobil. Myself and some of our other advisors are ExxonMobil focused, meaning Exxon's one of the core companies we work with. So it gives us the ability to kind of get into the details, understand the pension plan inside and out, the 401k, understand the loopholes and different mistakes that can be made to be careful about. So again, the pension, the 401k, healthcare retiree medical benefits, life insurance continuation, any questions you have, let us know. With our merger with Wealth Enhancement Group, we've now got over 100 offices across the nation. So rest assured, there's somebody you can speak to face to face, but we can always do web meetings, phone calls, email communication, whatever your preference is. And like I said, that cash flow analysis, that is complimentary. Take us up on that. If it's been over a year or two, go ahead and circle back to us again, and let's run a new one, because obviously a lot has changed in the course of those last couple of years between interest rates in the market. So with that, I'm gonna leave it up here so you guys can use your phones if you want to take a picture of one of those QR codes. We've got one getting into our LinkedIn, so if you want to follow along with us and get updates on future seminars, whether it be in person or web meetings or just the information we post on there. If you'd like to schedule a meeting with myself or one of the other advisors, you can get into that other QR code to get into our calendars, and we'll follow up with you there. If you want to get in touch with us immediately, 800 900 5867. Just ask for one of our advisors. And then also you can email us at info@theretirementgroup.com. So with that, I want to thank everybody for taking some time to join us. Again, this was just going through some quick questions. I'm sure there's plenty more you have. So again, pick up that phone and just give us a call, and I'll be happy to help you out with any questions you have. So we thank you, and we hope you have a great day.